Okay, here's chapter 6. Chapter 6, we're going to be going over closing entries, journalize, and posting entries. So, chapter 5 introduced and showed us how to use a worksheet. It covered prepping, adjusting entries, making financial statements. So, chapter 6 completes the accounting cycle, and you will see by the different slides, the different steps of the accounting cycle, and how the books are closed. So basically, when we close the books, we close out revenue and expense accounts to income summary. Then income summary is closed to capital, and drawings is subtracted from capital. So this is a relatively, let me see, this chapter should be probably about 35 slides. So we're going to journalize and sorry, let's go back to that. We're going to get to the right slide. Journalize and post-closing entries. So we're gonna, the closing entries, you journalize it, then you post it. So in the steps in the accounting cycle, we should be in step number 8 right now. We'll start with 7, 8, then we'll interpret the financial statements. So the 7th step is to journalize and post closing entries. So what is the income summary account? Basically, it's a special equity account that's only used in the closing process. Just to summarize what we did in the income statement. So the income summary account is a special owner's equity account that is used only in the closing process. So the closing process can be monthly, quarterly, annually. It's just every time you prepare financial statements, you'll have this closing process. So the income summary account, classified as a temporary owner's equity account. It does not have a normal balance, has a zero balance after the closing process, and remains with a zero balance until the closing procedure for the next period. So basically, remember with the T accounts, with assets, expenses, and drawing accounts, the debit increases, the credit decreases. So you're going to have two sides of the income summary account. The right side is going to be the expenses, because we're going to be closing expenses, and I'll show you the actual closing entries. And think of the credit side as the revenue side. When we close out revenues, we debit the revenues because normal balance is a credit. That debit will give it a zero balance and transfer over to the income summary account on the credit side. So let's see, there's 4 steps in the closing process. Like I had mentioned, we transfer the revenue account, we transfer the expense accounts, and that income summary, both of those accounts will go to the income summary account. Then the net of the income summary account will go to the owner's capital account. In essence, we're closing out the income statement to the balance sheet. And the 4th step is transfer of the drawing account, which is going to be a reduction to the owner's capital. So the closing process begins by closing on all the revenue accounts to zero. So here on the slide, we have 47,000. Fees income has a credit balance of 47,000. So here are the journal entries. Here's the balance of 47,000. So our goal is to get this to zero. So the journal entry, you don't have the actual journal entry here, but what we're doing is we're going to debit fees income to make that a zero balance, and we're going to credit income summary. So we're basically recording a decrease in the revenue account, debit it, which makes the corresponding income summary account a credit. So again, the goal here is to make a zero balance, and income summary now has a credit balance of 47,000. So for the closing entries, again, we're in the general journal, page 4. Up here, just like we did with the adjusting entries, we're going to put closing entries here. Fees income, and you don't really see a debit for revenue unless there's some kind of error or you're closing. So here's the actual journal entry for the prior slide. The word closing entries are written in the description column, so the accountant or bookkeeper can see. It's more of an audit trail. So basically we're going to do the same thing with the expenses. We're just going to reverse the debit and credit. So the income statement, the income section of the worksheet for Wells, that's the company we've been working with, has 5 expense accounts. So we're going to be doing this with all 5 accounts. Technically in a company you can have more than one revenue account. There's no rule, and there's no rule on what you want to name it. So I typically work with mortgage bankers, and they have, you know, their revenue accounts. Some of them just call it revenue, some of them call it origination income, some call it fees income, or have 2 different revenue accounts: origination fees, service premiums, interest income. Those all interest or all revenue accounts. Since expense accounts have debit balances, we have to enter a credit in each of these accounts to reduce it to 0. So the closing entry transfers total expenses to the income summary account. So here's an example. 5 expense accounts balances are reduced to 0. So the total of those expenses were $13,333. So all of that got transferred to the income summary again, which is a temporary equity account. So here we go. Income summary has a balance, which we just did. We closed that revenue. So utilities expense, these are the running balances. So utilities 650, rent 4,000, and so on. So we're going to close salaries expense, close utilities expense, see how these are making it 0, and close all of these accounts, including depreciation expense. And the total of all these will be 13,000. So if you think about it, your income statement, your whole income statement is right here, and we know what net income is going to be, because net income is revenues minus expenses. So that difference will be your net income. So here are the closing entries. So instead of doing like income summary salaries expense, income summary utilities expense, income summary supplies expense, we can put this in all one compound entry. Remember, a compound entry is a journal entry with has at least 2 debits or two or more credits. So here's a perfect example. So the income summary account reflects all the entries in the income statement section of the worksheet. Here's your revenue, here's your expense, here's your net income. There you go. So we have a third closing entry. So in the beginning I had mentioned that there was 4. This third one transfers that net income to capital. So what we're going to do is basically have income summary, make income summary a 0 balance, just like we did with the revenue expense accounts. So the journal entry to transfer net income to owner's equity is to debit the income summary and credit the capital. So remember, we had a net income, and the normal balance of capital is a credit. So if we increase capital, it's going to be a credit. We are making income summary account reduced to 0. We're getting that ready for the next period, whether that's a month, a quarter, or a year. So the net income is transferred to the capital account and it's increased by that amount. So income summary has a credit balance of 33,667. So to close it, we would debit it for the same amount and credit the capital account. So this is 0, and we're adding it here. So think of this as a statement of owner's equity. You're not going to have all the that's a financial statement, so you're not going to have all the information here as of now. So remember the statement of owner's equity: beginning balance, add net income. So beginning balance, add net income, subtract dividends. That's your increase and decrease of capital. Okay, general journal, closing entry. We debit income summary to zero that out, and we're increasing capital by that same amount. And the last one, step 4, which is our final step, the owner's drawing account has a debit balance and it's closed directly to the owner's capital. There's no income summary here. So there's 4 different entries. 3 of them use income summary. The last one doesn't. So withdrawals appear on the owner's equity statement as a deduction from capital. Withdrawals appear in the statement of owner's equity, which right here, that's a financial statement. So it's a deduction from capital. The drawing account is is closed directly to capital. Again, we're not using an income summary account. Drawing account balance is reduced to 0. So there's a big correlation. The same thing when we talk about closed, we're reducing to 0. Balance of the drawing account is 5,000 is transferred to the owner's capital account. So here's the balance of the capital account. Here's the balance of the drawing account. We're showing an example in T accounts. We're going to close the drawing, make this 0, and we're going to reduce capital by 5,000. So it's going to be 133,667 minus 5,000. And here's the closing entry. Debits equal credits. We are reducing capital with a debit, and we are kind of reducing drawing, for lack of a better word, because we're closing it out. So drawing typically has a debit balance. We're making it 0 by crediting it. So Carolyn Wells Capital will have a balance of 128,667. So let's go through this. Here's the balance. Here's the closing. Balance 0. We're getting ready for the next period. Capital account. Here's the balance. We add the net income. We subtract the drawing by debiting, and here's the balance. That's the ending balance as of, I didn't remember what the date was here. So you just say, for argument's sake, it was January 1st. Here's the January 1st balance. Here's the January 31st balance. So summary of closing entries. Know this for your homework assignment for sure this week. Actually, this is going to be in week 2's homework. So we have the date, description, post reference. This is how we know that we're going to post it to the ledger. Debit and credit. So the first entry, we close the revenue account. And how we do that is we debit income, fees, income, revenue, sales, all the same thing. And we credit income summary. Debits equal credits. Next step is closing the expense accounts. Remember, there were 5 expense accounts, and you can have a pretty huge entry here depending on how many expenses you have. I've seen companies with 3 expense accounts. This example has 5. I've seen probably like 20 to 25, so it can be really hairy. And in reality, you have computer software doing this for you, so it's just basically a click of a button. So income summary gets debited for the total amount of all the expenses. Then we close the income summary account. So right now it has a credit and a debit. That difference, so this right now has a balance of 33,667. If we take this minus this, the balance right now is a credit. So we have to make that to a 0. So we take this number to make it a 0. And we're adding that to capital. Then we close the drawing account, and that goes right to capital, no income summary account. We reduce capital, and we reduce drawings to make that 0 to close it out for the next period. So now all the closing entries need to be posted to the ledger. So remember, you have the general journal. So every time you hit the journal, you have to eventually hit the ledger. So when posting the closing entries, make sure you write closing in the descriptions. So we enter closing in the description. The ending balances of the drawing, revenue, and expense accounts are zero. These are also referred to, this textbook may refer to it as nominal or temporary accounts. Balance sheets accounts are permanent, income statement is temporary. So here's an example. Here's a general journal, and here's the respective, just for the fee income, the posting. So 47,000. So what we're going to do is we're going to post it, and again, this 401 represents the actual account number of fees income, and we put it, the 401 in here when we actually post it to the ledger. Could be kind of confusing, and you'll have that in, I believe, your homework assignments. If not in your homework assignments, it's going to be in your at the end of week 3. We have our first one of 2 mini practice sets, and I'll try to make a extra video for that to help you guys out. That's actually a big portion of your grade. So description closing on page 4 of the general journal, J4, we're going to debit fees income because we're closing it out. So here were the 2 transactions that we earned revenue for that period. We're closing it out to a zero balance. So here's the second part, the income summary. We're closing it out 47,000 credit, and that actually has a credit balance of 47,000. And just to basically, so we're going to have our expenses, then whatever that was, 13,333, we're going to have a debit balance when we do the expenses. Then that 47,000 minus the expenses, we're actually going to close income summary there too. So the remaining closing entries they're posted in similar fashion. So here's section 2. Prepare a post-closing trial balance. Excuse me. And that's just for the make sure the debits equal the credits on the permanent accounts, which are the balance sheet accounts. So we're going to interpret financial statements and review the steps in the accounting cycle. And this cycle happens every period, and a period is distinguished by when you're going to produce financial statements. So let's go ahead and prepare a post-closing trial balance and interpret that information. So a post-closing trial balance it's not a financial statement. It's a report, but not a financial statement. So the whole goal is to prove the equality of debits and credits after the closing process is completed. So remember, we actually had a trial balance where we prove the equality of those numbers, the debits equal the credits, after we did our original posting to the ledger. Remember, we summed all that up. This is the same thing, but after the closing process. So it verifies that the drawing account, revenue, expenses have zero balances. It only contains permanent accounts. They're not closed. Those are balance sheet accounts. So remember, balance sheet accounts, permanent accounts are not closed. Income statement accounts or temporary accounts are closed. So here we go. Name, post-closing trial balance, December. Again, balance sheet. Balance sheet items are a point in time, unlike the income statement and the statement of owner's equity, which will have a date range of a range of dates. So you have cash, accounts receivable, supplies, rent, equipment, 132,350, 132,350. So remember, the accounting equation is assets equals the sum of liabilities plus equity. So only permanent accounts appear on this post-closing trial balance. Includes assets, liabilities, and capital. So I spoke about the audit trail a lot. So in post-closing trial balance, so if the post-closing trial balance does not balance, you have errors. So we can use the audit trail to help us locate these errors. Sometimes it's mathematically. So if I have 691 and I put 961, if things are divisible by 2. So you have a few steps that the textbook gives you to locate some errors. But what I often see is just transpositions. So if you have 1010, it could have been 1001 or something like that. So always check your numbers and check it twice, even if you're using that calculator, do your calculations a couple times. Use the audit trail to trace through the accounting records. So interpret financial statements and think to yourself, what do users do with the financial statements? External, internal. So if you're a manager, what do you need to know? Like, what is my cash balance? How much customers owe me money? How much money does the business owe suppliers? What is our profit or loss? Those are the questions you should be thinking about. So from looking at the balance sheet, you can see that cash account has a balance of 11,350. Accounts receivable, you can see that customers owe us 5,000. So eventually, these claims to cash will eventually be turned into cash. So remember that journal entry just say this one customer owes us $5,000. When they pay us, we're going to debit cash for $5,000 and credit accounts receivable for the same amount or the amount that they're actually paying us. And that's going to reduce this. So just remember, accounts receivable will eventually turn to cash. Sure, do customers not pay? And we'll get to that in subsequent chapters where you actually write off something. But for the most part, a high percentage, or you hope a high percentage of your customers pay you if you do extend on credit. So if you do have an accounts receivable, that means the company does extend on credit. If they don't have accounts receivable, all the customers paying cash. So these are the questions that you want to know the answers to. So let's go back to that last one. How much do the customers owe the business? I'm sorry. How much, that was accounts receivable. How much does the business owe its customers? So suppliers. So we owe our suppliers, whether we bought supplies, equipment, anything here, supplies, equipment. In this example, it would just be these two right here. So these are claims on assets. These are also claims on assets. So you have creditor claims and you have equity claims. Financial statement for the income statement. Basically, what does this tell us? How much money did we make? Did the company generate a profit or a loss? And you can tell by reviewing this statement. So objective 4, last objective of the chapter. Step 5, we use the worksheet to prepare our financial statements. And those financial statements are the income statement. This is what we prepare first to get net income. Then we use that net income to fill out or prepare a statement of owner's equity. And the last figure on the statement of owner's equity should be the ending balance for that period. We're going to use that for the balance sheet. So if you have any homework problems or any type of problem, know that this is always going to be the same. Income statement first, statement of owner's equity second, and last, balance sheet. So journalizing and post-closing entries, what we're doing is we're transferring net income or the net loss to owner's equity, and we reduce the balances of the temporary accounts, which are the income statement accounts, to 0. So step 8, we prepare the post-closing trial balance, and step 9, we interpret that information. So here's a slide on the flow. So we have source documents. So let's review this. So you have source documents. That can be a receipt. A source document could be a bill you receive that the company owes a supplier money. You use that to look at that. Okay, a transaction has been made. I need to put a journal entry into the general journal. Let me go back to there. Then you post it. Then you'll put on the worksheet. And this is for all those transactions. So you have source documents you start with, post journal entries in the general ledger, or prepare journal entries, post those journal entries in the journal ledger, the worksheet. Remember, you have the trial balance, adjustments, adjusted trial balance, income statement, balance sheet, and you make the financial statements from that. So let me know if you guys have any questions, and I'll keep on making these videos for you.